N Jayakumar. Jakes is joining us from Prime Securities. Jakes, good morning. Thank you very much for your time this morning. We've been speaking after a long time. Jakes, you look at the global construct very carefully. This morning, CLS has come out with a note making a case that FPIs or FI flows as a percentage of GDP have been closer to 0.5% in, say, between FY 2014 to 2022 period. This 5-6 years, FIs have been on the lower side. Yes, in absolute terms, they've come. Now they're making a case that this number can rise to over 1% in the next few years. You also travel abroad. You have a very meaningful friend circle among FPIs. Are you getting a sense that they are warming up to India? Up till now, India rally has been powered by domestic retail money by a large extent. Can additional flows from FIs gather pace?
Well, the reality is that when so many people fall in love with a market, bubbles need to get created, as it were. Today, the bubble would have been created had it been everybody buying at the same time, sort of thing. The FPIs have been the contra, as I call them, to the local investors. And local investors have moved their savings allocation from about 2.5% 6 years ago to about 4.5 to 4.75% today into the markets. And this is the kind of tsunami we are seeing with SIPs coming in at about 18,000 crores or 18,500 crores per month. Given that kind of an orientation, the contra, which is the FPI selling, has continued right through. It's possible that when overseas allocations change and interest rates, the sort of the cool down in interest rates happen and greater allocation happens, it's possible then that you could have a sort of a confluence of factors coming in, maybe post elections, FPIs coming in, locals continue to buy, and there could be this kind of bubble formation where the markets could go up 10-15% in a very short period of time before valuations really become excessive in every sense of the word. Today, please understand that there are still headwinds that the Indian market is seeing. One of the headwinds, which recently has been earnings, for the first time this quarter has become some kind of tailwinds where every sector has performed and delivered way better than the expectations of the analysts. So earnings have been significantly better. Now that the earnings season is over, they've been significantly better. They will act as tailwinds. So discounting 25-26 is possible. The investment cycle is being set into place again. Therefore, there's capex additions, there's earnings that will come through higher capacities kicking in. The private sector is now stepping to the table in terms of investments along with the public sector. And to the extent that the Indian public has got more enthused and become more exuberant, almost bubble-like territory in certain very illiquid stocks or illiquid pockets. But with the FPIs also potentially able to come in as interest rates sort of either get capped or start declining in the West, I think you could have maybe a quarter or 2 quarters later a kind of a bubble-like movement in the market as, quote-unquote, everybody sort of falls in love at the same time with the Indian markets. So it's possible, and obviously the FPI flows have been at historic lows over the last, in fact, they've been negative as we've been seeing them. And to that extent, any shift in that FPI stance towards turning positive, I don't even need to overemphasize the fact how bullish that can be.
Sure. Jakes, you've given us so much food for thought, but let me pick up on the point that you were making about earnings, right? Because there's a stark disconnect. We all knew that it was a K-shaped recovery, and now it's getting magnified because what the urban focus earnings are as opposed to what rural India's suppressed earnings are, there's a clear disconnect there. What do you make of that in terms of an investment thesis?
Well, that's why if you see, for instance, a lot of the FMCG stocks aren't participating. They are direct beneficiaries or they are directly hurt if rural consumption declines. Urban consumption has been there. We've seen the credit card culture grow. People have been borrowing from the future to using credit to consume. That's an urban phenomena. Unemployment is an issue. Unemployment in various pockets. Rural employment is an issue. Rural consumption is an issue. So there are pockets of, should I say, disconnects or discordant notes in this orchestra that we're playing out about India. So from that perspective, I do believe that the markets have been rational. those who invested largely in FMCG, sort of evergreen stocks, the levers, the HDFCs from a banking perspective. So the overall pockets have been and will continue to be under pressure, and the overall pockets have been at the receiving end of sell-offs, and they haven't participated. And that to that extent, I think the markets have been very sensible and very pragmatic in their approach. So given everything, I feel that the market reaction, it's almost like the nursery rhyme that when she was good, she was very, very good. This is about the child in the nursery rhyme. And when she was bad, she was horrid. So when people like a certain sector, they go completely overboard. And if they don't like it, they dump and move on. And that's being seen in terms of some of the evergreen favorites now not having performed for the last few years, and some of the lesser known, lesser loved, undervalued perhaps, but not these sort of fancied spaces have been at the receiving end of money. And I think that's also true that if the mass participation is in certain stocks, like everybody loved in HDFC will not perform. And clearly everybody can't make money at the same time. And that's been frustrating to say the least for market participants. But again, flying in the face of traditional logic, you go into sectors that have a future. People thought that the coal-based or thermal is going out of fashion, and those are the stocks that have done the best. I mean, Coal India is a case in point. BHEL has produced loss after loss after loss, but because of the future being what it is, it's trading at multi-year highs. NTPC has done brilliantly. So if you just take, without recommending a stock or two, if you just take some of the PSUs which have been laggards in the past, but efficiency will come when inefficiencies get dropped off. And I think that's the way people are seeing the sales of the world, BHELs, OMCs, etc., where going forward, inefficiencies are being eliminated, capex is coming in, and the CEOs and the management and the board are being held more accountable for profit. So clearly the market's taking note of this, and surely they discount these things upfront, and no surprise in that.
Exactly, that's what playing out as far as the entire PSU pack is concerned. But Jakes, I want to talk to you about pharma space, especially the global construct which you shared with us, that large parts of Europe aging very fast. Even US is witnessing shortages of drugs, is what we are picking up. In this kind of a scenario, how do Indian large pharma companies and the regulatory glare on them pan out? So many of them have moved higher. I mean, 400 is almost 1,000 on Oro, 1,500-1,600 Sun Pharma. Things have rebound from lows. Do you still find value in some of these large players?
Well, absolutely do, because the reality is that the allocation to pharma in funds from an index perspective is still under 5%. One company accounts for 60% of that, which is Sun Pharma. Sun Pharma's market cap at 3,70,000 crores is 3 times the next person's. And there are a clutch of companies, 3-4 of them in the 1,20,000 to 1 lakh range. There is one company in the 85,000 range and a couple in the 60-70 range. For a company, for a sector which is so critical right now in so many parts of the world, not the least of them being India, with in the backdrop of things like COVID and recurring flus and multiple variants of the virus, propagating, etc. This space, to my mind, is way underinvested. So A, there is valuation comfort. B, there's under ownership. C, most funds have come in only from a tactical trading perspective. Stocks have moved up. Most of the companies here are low on debt, if not debt free. Most of them are huge cash flow generating companies, and they continue to marginally invest. So these are perfect recipes for a serious portfolio allocation that hasn't happened. And some of these actually are now benefiting from PLI, which is a move aimed at making India self-reliant on some of the key inputs for the pharma industry without being dependent on China. And they're also profitable. And the government also gives back in terms of concessions for investments made. So a combination of domestic PLI, US generics, multiple parts of the world, I think the space has just begun. Never mind the FDA glare. I think the positive side of the FDA is the FDA realizes how important India and Indian companies are. Their overdependence on China has actually been evidenced by interviews that they have done. They want to reduce. So will they take a more lenient view? I don't believe so. Will they take a quicker view in terms of audits and turnarounds? Absolutely. So most companies are now going through more audits because there are far many more approvals being sought for new drugs or new molecules, etc. Now, in terms of approvals, faster turnarounds are happening. In terms of corrective action, companies have become more responsive. So I don't believe audits are negative in any manner. Audits, in fact, indicate the heightened activity and the heightened approval seeking that these companies are doing. The response to that, both from a company perspective and the FDA perspective, is a lot more proactive. And my personal feeling is that people tend to get spooked on audits. It's like a speed breaker on a highway. You don't expect it, but they will happen. And there's absolutely nothing wrong in getting comments which you need to correct and move on. But unlike in the past, when certain large pharma companies had audit issues, import alerts or warnings which haven't been rectified for 3 years, today it's very different. Today the feedback and the turnaround is much faster. And I think that's a positive for the industry.
Jake, so where are those unloved or hated pockets in the market right now where you do see value, which everyone's not looking at right now?
Well, I think private sector banks that people had fallen in love with, the large ones quoting a 2.5, 3 times, 3.5 times book, they have fallen by the wayside. But a number of private sector banks are quoting at 1.25 times book. They become cheaper than their public sector peers. These are well-run, digitized banks. Capital adequacy is adequate. They're quick to change strategies. They're in both wholesale as well as the retail, largely retail. They're granular, and there are a few banks that are available. We don't always need to look at the industry leaders, the well-known top 2 or 3 private sector banks or 5 private sector banks. So below that, the love for PSUs has kind of ignored these. And as interest rates actually either ease or stay at these levels, but with interest rates start coming in, I believe that these private sector banks will get re-rated. So I think it's a matter of time. So private sector banks is one. The second is the entire move to thermal is so aggressive. And with the minister himself putting out targets like 88 gigawatts, etc. of thermal power, you're talking about companies that are in the PSU space and in the private space where thermal and power generation, and most importantly, the entire range of power and power equipment, because there are absolute bottlenecks galore in that supply chain. So if there's a problem on transformers, where there's a problem on certain key conductors, there is an entire range of power equipment that will come in, and I think there's a whole host of mid-cap companies in that space that will be beneficiaries. People shouldn't look at, I repeat, people shouldn't look at historic numbers to take a call on this space. This space over the next decade, I think, is going to meet with dramatic investments and dramatic opportunities. So the power and power equipment is the other one. Private sector banks I talked about, pharma I talked about, OMCs I think could go in for multiple re-rating, much like the way the Coal Indias, etc. have. So I think there's, there are enough spaces in the market where you can draw comfort from. Will it be a straight line? Never is. Will it be a space that most of the spaces I'm talking about have not been approached by a large segment of the market, either because earnings have been flying in the face of logic, or they've been weighed down by their the historical baggage of earnings and earnings multiple. And I think people need to shed that. So the biggest bane to my mind in the market is 30, 40 years of experience that some of us carry, 30, 35 years experience, where you need to shed that to look at the future differently. And I think that is what the market is. So whether I call it historical baggage, or I call it intellectual arrogance, or I call it, the legacy of the past, call it what you might, you can soften the blow, but you can't take away the fact, and you certainly can't take away the fact that some of us are weighed down by the past, and we need to view this market slightly differently, especially because younger, retail, more aggressive, more daredevil investors are coming in. So, I think casting that, you need to learn from the past, but you can't ignore the present. And I think therein lies the truth.
Very interesting. Jake, thank you very much for joining us. In fact, as we